Right now, somewhere in Australia, someone just hit $100,000 in their bank account, and now they're staring at that number on screen, asking the same question you probably are. What can I actually do with $100,000 in 2026? Because here's the thing most people won't tell you. $100,000 today is not what it was 5 years ago. Inflation is sitting at 4.0% based on the latest ABS CPI data for the 12 months to May 2026. The RBA has held the cash rate steady at 4.35% at its June 2026 meeting, with markets pricing in the possibility of a cut later in the year rather than another hike. The national median house price across combined capital cities has now crossed $1.16 million, and the cost of living for a single person in Australia is now running between $2,500 and $3,500 a month before rent. So if you leave that six-figure number sitting idle in your account, inflation alone strips around $4,000 of its purchasing power every year. Let's break down what $100,000 can really do for you right now, starting with the option most people overlook. If you've got a HECS help debt, listen closely. The government reduced all outstanding student loans by 20% in 2025. But your remaining balance still gets indexed every year. And with inflation running this hot, that debt silently grows while you sleep. If you owe $40,000, indexation at 2.8% adds roughly $1,120 in a single year. Paying down or clearing that debt with part of your $100,000 could be one of the highest guaranteed returns you'll ever get. And while you're wiping out debt, take a hard look at any credit card balances too. Australians collectively hold more than 12 million credit cards, with the average interest rate on purchases sitting around 20.99%. If you're carrying even $5,000 on a card at that rate, you're bleeding roughly $1,050 a year in interest alone. Clearing that with a fraction of your $100,000 gives you an instant 20.99% guaranteed return. Now, let's talk about the option everyone's favourite uncle brings up at Christmas: property. The median house price across Australian capital cities is now $1.16 million. Sydney's median is around $1.24 million. Brisbane has climbed to about $1.08 million. Perth is sitting around $1.09 million. So can $100,000 actually get you into the property market? Yes, it can. The government's expanded 5% deposit scheme now has no income caps and no place limits for first home buyers. A 5% deposit on a $750,000 property is $37,500. Your $100,000 covers the deposit, stamp duty, conveyancing fees, building inspections, and still leaves you a financial buffer. You're not scraping in by the skin of your teeth. You're entering with breathing room. And that breathing room matters enormously right now because although the RBA has held the cash rate at 4.35%, variable mortgage rates are still sitting near their highest levels in over a decade, and unexpected repair or holding costs can hit hard in the first year of ownership. But maybe property isn't your play right now. Maybe you want your money compounding while you focus on your career or your family. Let's talk about the share market. The BetaShares Australia 200 ETF, A200, returned around 6.3% over the 12 months to the 30th of June 2026, with a 5-year annualized return closer to 11%. The Vanguard Australian Shares Index ETF, VAS, has delivered around 10.4% annualized over 3 years, with 1-year returns closer to 6%. If you dropped $100,000 into a diversified ASX ETF and it returned an average of 8% per year, you'd be sitting on around $146,000 in 5 years without adding another cent. And thanks to franking credits on Australian dividends, your effective after-tax return gets even better. Now, if you want zero risk while you plan your next move, there's always the savings account route. The best high-interest savings accounts in Australia right now are offering intro rates as high as 5.90% per annum through providers like Rabobank on balances up to $250,000. While ongoing bonus rates from banks like ING, ME Bank, and UBank sit in the 5.00 to 5.50% range. On $100,000, that's roughly $5,000 to $5,900 a year in interest. That's around $450 a month landing in your account for doing absolutely nothing. Just watch out for the fine print. Most bonus rates only apply if you meet specific monthly conditions like depositing a set amount, growing your balance, or making a certain number of card purchases. Miss one of those conditions and the rate can drop to under 1% for that month. So set a calendar reminder, automate the deposit, and treat the conditions like non-negotiable bills. And if you want certainty, 12-month term deposits from major banks are currently sitting between 4.20 and 4.70%. $100,000 locked in at 4.50% pays you $4,500 over the year, fully backed by the government's $250,000 deposit guarantee. Here's one most people skip entirely: superannuation. The concessional contribution cap for 2026 to 27 has just increased to $32,500 from the 1st of July 2026. If you're earning over $45,000, every dollar you salary sacrifice or personally contribute and claim as a deduction is taxed at just 15% inside super instead of your marginal rate of 34.5% or higher. Dropping $32,500 of your $100,000 into super could save you well over $6,300 in tax this financial year alone, while supercharging your retirement balance decades ahead of schedule. It's not exciting, but it's one of the most powerful wealth moves available to everyday Australians. Now, what if you used $100,000 to build something instead of buying something? In Australia right now, you can launch a mobile food van, a cleaning franchise, or a service-based business for well under $100,000. The rest becomes your runway, your working capital, your safety net while revenue builds. The fastest growing sectors in Australia for 2026 include healthcare, retail trade, and digital services. You don't need a massive operation or a flashy office. You need a lean model, a real problem to solve, and enough capital to survive the first 12 months without panic. $100,000 gives you exactly that. But here's the move that nobody talks about, and it might be the smartest of all. What if you split it? $30,000 into a high-interest savings account as your emergency fund. $30,000 into a low-cost diversified ETF for long-term compound growth. $20,000 toward clearing high-interest debt or wiping out your HECS balance. And $20,000 kept liquid and ready for the right opportunity, whether that's a property deposit down the track, a business idea that clicks, or an investment you haven't discovered yet. The advantage of splitting your money this way isn't just about diversification. It's about protecting your future self from making one big emotional decision. When your $100,000 is spread across 4 buckets, no single mistake can wipe out your position, and no single market move forces you to sell at the worst possible time. The real danger with $100,000 isn't losing it in a bad investment. It's letting it sit in a standard transaction account earning next to nothing, while inflation devours around $4,000 of its value every single year. Doing nothing with $100,000 is the most expensive decision you can make in 2026. Here's what it comes down to. You now know what $100,000 can do across property, shares, savings, super, debt, and business in Australia right now. Not in theory, in real numbers, with real rates, in the actual economy we're living in today. Most people with $100,000 will do exactly what they did last month. Nothing. They'll check their balance, feel good for a second, and let another year of inflation eat into it. But you just spent the last few minutes learning what they won't bother to research in a year. That puts you ahead. If you got value from this, do me a favor and hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next one. I'll see you there.